day, everyone. You're welcome to this week's Business and Investment Tips program, a production of RCCG Christ Church Radio with Ayodeji Ebo, an investment professional. This week, we will focus on understanding equity capital offerings, public offerings, and right issues. The Nigerian stock market is currently awash with equity capital raises via public offerings and right issues. Hence, we thought it is important to provide details on equity capital offerings and application process and our views. Equity capital refers to the funds a company raises by issuing common or preferred stock shares. When investors purchase their shares, they become partial owners or shareholders of the company. Equity capital represents ownership in the company and gives shareholders certain rights, such as voting rights in major company decisions and the potential to receive dividends if the company distributes profits. Companies may raise equity capital through various means, such as initial public offerings, IPOs, right issues, or private placements, depending on their strategic objectives. Following the recent announcement by the CBN on recapitalization using only equity capital, Nigerian banks have begun this process to shore up capital. Currently, Fidelity, public and rights issue offer, and Access rights issue offer are the only banks to open their official programs, while GT Bank and FCMB have yet to do so. We expect more banks to follow this path in the coming weeks. The two common ways of raising equity capital are through rights issues and public offers. What is a right issue? A right issue is a way for a company to raise capital by offering its existing shareholders the right to buy additional shares at a discounted price, typically compared to the current market price. This is a common method for companies to raise capital while giving existing shareholders the opportunity to maintain their proportional ownership without dilution if they choose to participate. What is a public offer? A public offer is a sale of shares by a firm to the public to raise funds for the company. The funds raised can be used to expand the business, pay off debts, or even distribute dividends to shareholders. Now, how do you participate? Public offering. 1. Research the offering. Understand the details of the public offering, including the price, the company's financial health, and its future prospects. 2. Contact your stockbroker. You need to set up a stock account to have a CSCS account through a stockbroker. This is the account that would hold your stock. Opening the stock account is free. 3. The offer form. You can access the offer form through the stockbroker or any of the company's accredited platforms. Complete the form and submit it through the receiving agents. It could be the banks, stockbrokers, or registrars. You also make payments based on the number of shares you wish to subscribe to. Please include your CSCS number. 4. Upon success and allotment, your CSCS account will be credited with the shares. Now, right issues. 1. Confirm the qualification date. This is the cutoff date for shareholders to qualify for the rights. If you purchase the shares after the qualification date, then you will not be entitled to the right issues. For instance, Fidelity and Access Bank's qualification dates are 5th of January 2024 and 7th of June 2024 respectively. You must buy on or before those dates to qualify. 2. Understand the rights program. If you qualify for the rights offer, confirm the firm's right program. For instance, if the program is 1 new share for every 2 existing shares you own, and you have 100 shares, you have the right to take up 50 shares at the rights price. 3. Complete and submit the form. Complete the form, submit it through the receiving agents, it could be the banks, stockbrokers, and registrars, and pay for the rights. 4. Credit to CSCS account. Upon success and allotment, your CSCS account will be credited with the shares. 5. Option to sell rights. If you are not taking up the rights, you can sell your rights through the broker if the market price is higher than the rights price. Else, do nothing. Here's our view on the current offerings. Public and right issue offerings are issued at attractive prices relative to their current market prices, which provide an incentive to investors to participate rather than buying the shares directly on the floor. However, we observed that in recent times, the offers are issued at almost or below the market price. When you consider the waiting period you have to wait to have the shares allotted to you, it may be rational to purchase directly at the market price relative to the public and right offers. That said, the banks still have long-term upside potential, hence, positioning should be for the long term, either public offerings or secondary market purchase. Please consult your financial advisors before making any investment decisions. Implications of offerings, post-offers. 1. Increase in shares outstanding. The number of available shares of the company would increase after the close of the offers, which means that in the short term, the per share data like earnings per share, dividend per share, and other market multiples would decline. For instance, if a company comfortably paid a dividend of 90 billion naira last year, translating to a dividend of 3 naira per share, with shares outstanding of 30 billion units, then an increase in the shares to 40 billion units post-offer will reduce the dividends per share to 2.25 naira if the same amount of dividend payout is maintained. To maintain the same dividend per share, the firm will have to pay 120 billion naira. However, in the medium to long term, if the capital is properly deployed into profitable opportunities, the company will earn more income and will be able to pay more dividends. 2. Potential decline in share prices. Due to the increase in shares outstanding and investors' dividend expectations, share prices are likely to decline after equity capital offerings in the interim, but improve in the long term based on the firm's financial performance. Participating in equity capital offerings can be a great way to invest in a company's future growth. It is important to note that stock investing is for long-term investors with high-risk appetite due to the volatility of share prices up and down and the risk of value destruction. Thank you for listening. Please join us same time next week for another exciting and insightful session. For questions, comments, and feedback, kindly forward to ebo.ayodeji@gmail.com or send an SMS to 07082463747. Stay blessed.